One of the things that I enjoy most about the stock market is looking into new businesses, especially small cap businesses that nobody has ever heard of. So far, the Russell 2000 is up only 6% year to date. This is trailing the S&P 500 as well as the Nasdaq. So there are clearly some opportunities sitting out there in these small cap companies. So today we are going to take a look at three different companies. And the very first one is Big Bear AI Holdings, ticker symbol BBAI. The stock price right now is sitting just over $5 per share. And the company has a market cap that is under $2 billion. And year to date, Big Bear AI is up almost 24%. However, that does not come without an extreme amount of volatility. At the start of the year, it was trading for around $4 per share. However, it ran up to almost $10 per share, continued by a drop to around $2.40 per share, and then another run up to almost $8 per share. And now we are seeing a little bit of cooling off as the stock is traded back down to around $5. But of course, it's very important to understand what the business actually does. In my opinion, they are most comparable to a Palantir. They are collecting data within an organization or even within the US government, and then using that data, presenting it in a way to allow decision makers to make educated decisions on what they want to do within the business or within the US military or US government. However, despite Palantir and Big Bear AI being in similar markets, they have vastly different financial situations. Palantir is expected to put up around $4 billion of revenue in this year. However, for Big Bear AI, they are only expecting revenue for 2025 to come in around $125 to $140 million. So they are about 1/30th the size of Palantir. And on top of that, while Palantir is growing their revenue by almost 50% year over year, Big Bear AI is seeing their revenue contract by about 18%. They brought in $32.5 million in the second quarter of 2025 compared to almost $40 million in the second quarter of 2024. And also, Big Bear AI is not yet to a stage of profitability. Their net losses are actually increasing dramatically. For the second quarter, they had a net loss of $228.6 million. That compares to a net loss of $14.4 million in Q2 of 2024. So they are actually seeing their net losses increase year over year by a significant margin. And right now, analysts don't see them turning a corner until 2026. For 2025, they're expecting that EPS will come in at negative $1.10, and revenue will actually decline by around 16% year over year. However, in 2026, they are expecting the business to correct itself slightly, getting closer to profitability, only losing around 32 cents per share, and revenue actually climbing by almost 14% to around $152 million for the year. The thing with Big Bear AI is they are not Palantir, and anyone telling you that they are is not looking at the numbers behind the business. Big Bear AI, what they do have going for them is they are a small cap company in a market that has a ton of potential. Their market cap, again, is under $2 billion, while Palantir's market cap is almost $370 billion. So there is plenty of room for Big Bear to capture some of Palantir's market. A famous saying by Jeff Bezos is, "Your margin is my opportunity." And right now, Palantir has a huge margin, and that means there's plenty of room in that market for some other players to come in and steal market share. And that could be Big Bear AI if they execute at a high level. And that is probably what is most exciting for Big Bear AI, is they don't have to capture the whole market. They can take a small sliver of this market and the company could still 10x in value. A 10x from their current market cap would still only be a $20 billion company. The next company on this list is TravelZoo, ticker symbol TZOO. They're trading at a stock price of just under $10 per share, and the market cap on this company is tiny. It is sitting under $110 million. Year to date, the stock is down by over 50%. Before we get into exactly what this company does, I want to comment on their logo because it looks like someone made it in PowerPoint back in like 2000. But it's very obvious what they do. TravelZoo is a travel company. They are helping people book vacations all around the world. And whether it's a getaway for just a weekend, a full vacation where you're taking a week off of work, traveling to Mexico, traveling to Europe, wherever it may be, they are trying to help you book that vacation and get everything arranged from flights to hotels, whatever it may be. As of TravelZoo's most recent quarter, they have been able to grow their revenue by 13% year over year to $23.9 million. However, their EPS numbers have taken a hit. A year ago, they were putting up 23 cents of EPS. It has now fallen to 12 cents of EPS. And the main reason for this drop in EPS has to do with customer acquisition. They are focusing on growing the subscription side of their business, which is called their club members. And in the second quarter, it's costing them around $38 to acquire a new customer into their club members. However, over the course of the first year, this subscription should yield at least $40 in subscription fees, plus an additional $18 in other transactions. And here's how that breaks down in terms of EPS numbers. In Q2, they took a hit of about $2.8 million for acquiring these new customers. That resulted in a negative EPS of around 18 cents per share. However, over the quarter, they also increased EPS by around 5 cents per share, so they resulted in a net loss of 13 cents per share in Q2. However, over the next 2 quarters, they anticipate around 14 cents of EPS, which should offset that loss. And then moving forward, they're anticipating around 20 cents per share of increased EPS due to these acquisitions. If they execute this well, this could be a big growth vector for the top and bottom line of the company. However, the big question is around churn. How many of these new customers coming in will actually turn over within the first year? If they have a very high churn number, then we could see these results kind of continue into the future where they're paying a lot of money to acquire new customers, and then those customers are leaving after 6 months, maybe a year, whatever it may be. However, if they are able to maintain these customers for a number of years, we should see the company's profitability go up in a major way. For 2025, analysts right now are expecting the company to take a hit on their EPS numbers. And this is consistent with what management is expecting. They're expecting EPS of 76 cents for 2025. This is non-GAAP EPS. Keep that in mind. That is down from $1.06 of EPS in 2024. However, in 2026, they are expecting this EPS number to double to $1.42 of EPS. This is also coming along with strong revenue growth. We are seeing 12% growth in 2025, or at least that's what analysts are projecting. And then in 2026, they're expecting even stronger top line growth of 16%. Here's the thing with TravelZoo. If the economy is doing well, this is a company that should do pretty decent. As people are kind of looking to take vacations, they have additional income that they're confident spending on a vacation for their family. That is when TravelZoo should capitalize on a very strong market. What we could see going into 2026 is if interest rates are cut, we could see consumer confidence start to increase, and that could actually lead to an increase in vacations. And if we see that occur and EPS come out to where analysts are expecting $1.40 of EPS, a double from what they're expecting in 2025, then the stock price for TravelZoo should move up in a massive way. The final stock we have on this list is Opendoor Technologies, ticker symbol OPEN. Right now, their share price is around $4.50, and the market cap on this company is sitting just over $3 billion. This is a company that IPO'd back in 2020, and they saw a massive run up when a lot of these spec stocks were going crazy in 2021. They spiked up to a share price of almost $35 per share. However, over the course of the next few years, they sunk all the way down to 50 cents per share in June of 2025. However, over the course of the last year, we've seen the stock run up by almost 130%. And from these lows of 50 cents, we have seen the stock go up by over 700%. And what Opendoor aims to do is they aim to take the hassle out of buying and selling your home. What they're trying to reduce is they're trying to get rid of the middleman, the real estate agents that help you list your home and get it sold. At the end of the day, they are trying to create an online platform where you can sell your home directly to a buyer at a very easy and low cost. Overall, I really like this business model. However, they have not yet seen a ton of growth. They generated around $1.6 billion of revenue, which is up only 5% year over year, and they are still losing money. They came in with a net loss in their most recent quarter of around $29 million. However, the company did deliver their first adjusted EBITDA profitable quarter, and this tends to be a precursor for profitability in terms of GAAP EPS numbers. So we could see over the next couple of years, Opendoor actually achieve profitability. Here's something that I think is very important to keep in mind if you are looking to purchase this stock. They did sell around 4,300 homes in the second quarter of 2025. However, they also purchased around 1,800 homes in this quarter. That means that if we see a lot of concerns with the economy and the housing markets start to crash, Opendoor is going to be in an incredibly scary situation because they do have a lot of homes sitting on their balance sheet. However, the reverse is also true. If we see interest rates fall and this actually drives up demand for people moving and buying these homes, we could actually see a lot of these prices increase and Opendoor come out with a lot of good revenue from these home acquisitions. Personally, I don't love to see this in a company. I want to see them have a sole focus on the main mission of their business. We saw something similar happen with Zillow a couple of years ago. They started to try to flip homes, and what it ended up doing is bringing a lot of these homes onto their balance sheet and actually making the company as a whole look very bad. They ended up selling out of a lot of these homes at a loss and losing money. So if you're focused on flipping homes, then have that be your business model. However, if you're focused on cutting the middleman out and offering a platform for people to list and sell their homes on, then make that be your main mission. And I think that's reflected a little bit in analyst expectations for the next couple of years. For 2025, they are expecting revenue to fall by almost 22% and EPS to come in at a loss of 26 cents. And I think this lack of focus leads to underwhelming numbers in 2026 as well. EPS basically staying the same, a loss of negative 25 cents, and revenue only growing by 8%. So in my opinion, when we look at these three companies, I think the most interesting is TravelZoo. Again, it's down around 60% from its recent highs. If it were to fall another 20-30%, I think that would be a very interesting entry point. I also think that BBAI has a big opportunity in front of it. If they are able to capitalize and get a lot of different contracts set up with the US government as well as commercial businesses, we could see that stock soar in a major way. Again, because they just have to capture a small piece of a very large pie. Opendoor Technologies, I have the most concern with out of these three companies. One, the stock has ran up in a major way, but two, they are focused on the wrong thing in my opinion. They are acquiring all these homes, and in my opinion, they need to be focused on building out their marketplace and getting more users to actually list their homes on their markets. If they focus on the flipping game, that is all about timing, and maybe they will end up with good timing in 2026. However, I think it's hard to tell right now, and I don't think it's worth the risk. But of course, don't buy a company just because some random guy on YouTube talked about it. make sure you do your own research and look into companies that meet your risk tolerance as well as your time horizon. I personally do not own any of the companies that we talked about in this video. Keep that in mind as well. But again, I think the one that I'm most interested in is TravelZoo. I'd love to hear your thoughts down below. And while you're down there, drop a like on the video and subscribe for more videos like this one. And as always, have a wonderful rest of your day.